Good evening, viewers. This is CPH House Cafe, and today we are going to continue with our series on financial reporting. And our topic for today is going to be Ifrs 15, that is revenues from contracts with the customers. As we discussed earlier, that when we are looking at these IFRSs, we try to get much about into the new standards that has been introduced. And this is one of the second standard that was introduced recently, and it was introduced starting first, it was effective 1st January 2018, and it replaced some of the standards as we are going to be seeing. So basically, before we dive in, allow me to take off my video so that you can be able to concentrate on the screen and be able to get the information as we are going to be saying. Okay, we can now resume with our IFRS 15, that is revenue from contracts with the customers. As the standard suggests, we are going to be looking at some of the revenues that we are getting when we are engaging with the customers in terms of signing an agreement with different customers, whether they are going to be long-term or they are going to be short-term, as we are going to be seeing. But as far as the standard is concerned, we are going to have certain items, or what we call the learning outcomes. If anyone is going to be watching this video on IFRS 15, these are the things that you are expected to get until you complete the whole video. One of the things we are going to talk about, some of the terminologies that have been introduced. Remember, when these standards are replacing the old standards, it means that there are certain items that are going to be introduced within the coverage or within the scope. And we are, as our learning outcome one, we are going to be looking at the terminologies that are used within the IFRS 15. Secondly, we are going to look at the recognition, that is, how do we recognize that we are going to be having revenue? And that is basically some of the item that has been changed from the old standards, because the old standard used to recognize the revenue as when the risks and the rewards have been transferred to the person who is supposed to receive the revenue. But using this, or as per the new standard, we are going to look at the 5-step model that is going to help us understand how are we going to be recognizing that we have actually earned revenue from the contracts that we are going to be engaging with our customers. The third outcome is going to be the performance. We are now going to look at the performance obligations. These performance obligations, they are now the new terminologies that have been introduced as far as the upgrade of the standard are concerned. And we are going to look at how are we going to satisfy the performance obligation at a point in time or over time. If at all you are supposed to do certain kind of work, or you are required to do a number of tasks in the future, how are we going to be satisfying that? So the next one, we can look at some different or some types of contracts that are resulting into losses. There are those loss-making contracts. How do we account for them? Or how is the standard approach those contracts that are mainly resulting in losses when someone does or when someone engages in those contracts? Then the other one, we are going to look at the contract modification. If the contract has been changed, there are certain items, if maybe the person was required to supply maybe 10 tons of, let's say, beans, and you find that the person is now required to supply maybe 15 tons. If the contracts are going to be changing, if the contract is going to be changing, then we need to know that is it resulting into a new contract, or it is going to not result into a new contract. Those are the things we are going to be looking at. Then finally, we shall look at how are we going to account for these contract costs. What are some of the costs that we are going to be capitalizing, and what are those that we are going to be expensing as far as the standard is concerned? So basically, that's what I expect, or that's what you should expect. By the end of this video, you will be able to learn and answer some of the queries that may arise as far as IFRS 15 revenues from contracts with the customers is concerned. So without wasting more time, let's kick off and try to look at the terminologies. What are some of the items that we need to know their specific definitions according to the new standard? We are saying that IFRS 15 revenues from contracts with customers replaced both IS 18 revenue and IS 11 construction contracts. And these were basically the 11, it was 11 from maybe the short-term contracts, but this IS 11 was all about those contracts that are going to be taking a long period of time, and their performance is going to be satisfied over time. So basically, this IFRS 15 combined those two standards, and it was effective commencing 1st January 2018. Remember, this is our second newest standard. The first one was IFRS 16 leases, which was introduced 1st January 2019, but this one was for 1st January 2018. What it means is that if you are to look at some of the numbers that we are going to be doing in this standard, it means that we are supposed to look at those questions that are going to be prior to 1st January 2018 up, then going forward. Because those questions that are going to be coming before 2018, they are going to be examined, or they were examined basing on the other standards that were replaced. So whenever you are doing some revision, make sure you are looking at numbers that are starting from 2018 going forward. And we are saying that IFRS 15 sets out the rules for recognition of revenue based on the transfer of control to the customer from the entity supplying the goods. Here, what we are trying to mean is that there are certain recognition criteria or conditions that we are supposed to fulfill before we say that we have actually received the revenue. We are going to see those conditions as we progress through. For now, let's try to get some of the terminologies that are going to be used within the standard. Most of the key definitions that we need to know, one of them is control. And we are saying that control, this is defined as the ability to direct the use of and obtain substantially all the remaining benefits from the asset. If someone has a control over the asset, it means that person is able to derive all the benefits that are incorporated within the use of that asset. The person can direct where the asset is supposed to be employed, or where the items are going to be used, and determine how much they are supposed to be getting from that without getting any interference from different stakeholders. Because you may find that someone says, I own a certain item, but in actual sense, the person cannot use maybe the asset as a whole when there are certain restrictions. So if someone is controlling the asset, we are saying that you are able to direct the use or the purpose for that asset, and you are also able to get the benefits that are associated with the asset. That's basically what control is all about as far as the standard is concerned. The other one now we are going to look at is a contract asset. A contract asset, as the word suggests, it is an asset. But how is this arises to be an asset within the standard? And here we are saying that this is like an entitlement of the entity to receive a given amount of money upon certain conditions, or after fulfilling certain conditions, and that's basically the performance of the activities. We are saying that this refers to an entity's right to consideration in exchange for goods and services that the entity has transferred to a customer when the right is conditioned on something other than passage of time. For example, an entity's future performance. What we are trying to look at here is that if actually the person has delivered certain items to a given customer, the company expects to receive a given amount of time, of money. The money it doesn't necessarily mean that if you transfer the goods and you satisfy the needs of the customer is supposed to pay you there and then. Since we are using accrual basis when you are preparing these financials, you may find that you may deliver or you may do the work now, or you may do the service, provide the service now, but the payments are going to be made in the future. Basically, we can try to look at an example. If let's say you have acquired a contract, maybe you are required to supply a given tons of coffee, maybe to a given company. And the company within the contract that you've signed with that company, it stipulates that for you to start demanding payments, maybe you are supposed to deliver a certain kind of items. Maybe for you to start receiving the payment, you must have maybe submitted, let's say, 10 tons of coffee to that company for you to start receiving that money. But what will happen is that if at all you have not supplied those 10 tons to the company, you will not be entitled to any payment. So that's basically what we are trying to look at, that if the company does not supply as the condition states in the contract, then we are saying that the company is not going to receive the payment until it reaches the agreement that was signed in the contract. So if maybe the company has been supplying, maybe it has been supplying some tons of coffee to the organization, and you find that they have actually been supplying the goods, but they have not yet reached the minimum requirement for them to start receiving the payment. What it means is that they have already earned that money. It's like unaccrued income. It is money that has been earned, but you have not yet received it because you have not met certain criteria, which comes in as an asset. That's basically what we are trying to talk about when we look at the contract asset. Maybe the other example you may look at is if, let's say, the company has got a contract and it's supposed to supply maybe 200, maybe it is supposed to supply 500 computers as the full contract. The company has got a contract to supply 500 computers. But you find that within the contract, maybe you may find that the contract says for you to start receiving the money or the first installment of the whole contract amount, you must have supplied maybe 250 or 50% of the total supply. You are supposed to supply 500 in total, but for you to start receiving the money, there is a minimum supply you must have made for you to start receiving the deposits. And if it reaches a time and you want to get the money, but you have not yet supplied half of the quantity that is needed, you may find that you will not be able to get the money. But the money is there, you have worked for it. It is just that you have not actually earned it since you have not yet met the condition. That's basically what the contract is, the contract asset is all about. The other one we can look at is a contract liability. A contract liability is just the opposite of contract asset. And how do these contract liabilities arise? This happens if, let's say, the organization has received the money before supplying the goods or the services that is supposed to be supplied. Maybe you have got a contract and maybe the contract is to supply 500 computers, and you find that before even you supply any item, they have actually given you some money before you start supplying the computers to the organization. What will happen is that you have actually received that money, but you have not yet worked for that money. It means it is going to be a liability. It becomes a liability to you is that because it creates an obligation that you are supposed to deliver for the money you actually received. That's why when you find that if you receive money and you have not yet actually worked for it, you find that in the financials, we remove that money because that money doesn't belong to the financial year that we are supposed to be incorporating. So that's basically what I can talk about in brief as far as the standard is concerned. Then the other item we may look at is a standalone selling price. A standalone selling price, as the word suggests, it's a standalone selling price, meaning something, the price that belongs to a certain item. But what happens in a contract arrangement is that sometimes these goods and services, they are supplied in a group. You may find that the company is delivering certain items at a given price when they are in a group. But for the standalone selling price, we are trying to look at what will be the price of each item that has been included in the group. If at all that item can be sold on its own, or that item can function on its own, then we assign a value on those goods. But mostly what happens in these contract arrangements is that sometimes these goods are sold in bundles. You can talk about maybe this multi-choice, the DSTV. You find that these DSTV guys, they sell their decoders and the dishes plus a 1 month subscription that is free, but it is incorporated within the cost of the dish and the decoder. So by the time the person acquires or buys that decoder and that dish, that person is also entitled to a 1 month subscription that is free upon paying the whole amount. You may find that maybe they are selling the dish maybe they are selling it at 180, but you find that when you buy it and they install that dish, you may find that you are going to find a 1 month subscription that has been paid. But what we are trying to look at here within the standalone selling price is that what is the price of the subscription that you have that is incorporated within the cost or the total contract cost? And what will be the cost of the dishes plus the decoders if at all someone wants to buy those items? We're saying that the standalone selling price, sometimes we find goods that are sold in group or in bundles. We've talked about these DSTV where they sell to you item, and after selling to you the item, they give you a 1 month free of the 1 month subscription on top of the amount you have, on top of buying the dishes. Then the other one, we may look at these telecommunication companies. If you are to, maybe if you want to buy their data bundles and minutes, you find that you may go and try to discuss what are some of the things they can offer to you if at all you want to subscribe maybe for a 1 month or a 1 year subscription for maybe the data or minutes. You may find that in the proposal they may say that if at all you are going to be paying this and this amount, we are going to give you the monthly data or the quarterly data plus maybe giving you these headsets or the handsets that you can be using for making calls, and that thing they may give it to you for free upon purchasing the monthly data or the quarterly data, whichever arrangement that they are suggesting. But what this standard suggests is that if you are to look at what will be the cost of those handsets they are going to give to you, and what will be the cost of the monthly data when someone is not going to be given a free handset. So basically that's what we are trying to look at as far as the standalone selling price is concerned. We are saying that even if something has been given to you for free, we have to determine what is the cost. So long as that item can function on its own and someone can buy, or it can result in a performance obligation, someone can buy that item and use that item separately, then we need to determine the cost of that item separately. That's basically how we can describe the selling price, the standalone selling price. We can resume to determining. We try to look at the recognition of revenue. We said when this is mostly the item that has been introduced, that is a bit different from what you use to account for the revenue. And we are saying that when you're recognizing revenue, there are 5 steps, or there is a 5-step model that we are supposed to go through before we recognize that we have actually received the revenue. So when all these conditions, these 5 steps are fulfilled, we can now say that we have actually earned revenue. One is that we are going to be looking at how the 1-step model is, the first one is identify the contract with the customer. Identifying the contract with the customer. Here we are trying to look at what are some of the indicators that you have a contract, or what shows that you have a contract with the customer. If someone says, I have an engagement, or I have a contract with that customer, what can we use to say that we actually have a contract with the customer? These are some of the items that we look at, and we tell that the person has actually a contract with the customer. One, we are saying that the parties have approved the contract and they are committed to carrying it out. If you have gone into an agreement and all the parties have agreed, they have actually agreed to do whichever kind of task that has been agreed upon by the two parties, then we have it gives us a brief information that at least these people are going to be having a contract, which means that either side of the party, these parties, the two parties to the contract, they are committed to carrying out the contract they have actually signed. But if you find that one of the parties is not willing to do the needful or to do what they are supposed to do as far as their contract is concerned, then we can't say that we have a contract with a customer. Then the second one we are talking about that each party's right regarding the goods and services to be transferred can be identified. And when you're talking about these parties, the parties to the contract, if maybe they are dealing in buying and selling, because that's mainly the things that we always do, is that we are supposed to be having these parties may include the buyer and the seller. If those parties, their rights, what they are supposed to do towards the contract is known. One of the things, the buyers has a right to receive the goods. If I have actually ordered for some goods, then I expect you to be delivering the goods to me as the buyer. And upon delivering those goods, we expect that even the buyer has a responsibility to pay the seller, meaning the seller has a right to receive payments for the goods they have actually supplied to the buyer. So that's what we mean by saying that each party's right regarding the goods and services to be transferred can be identified. The buyer has a right to pay, and the seller has a right to receive the payment. Then the third item is that the payment terms for the goods and services can be identified. If you can't identify, remember these items we are going to be looking at, you should be able to attach a value on certain items that you are going to be seeing. We are seeing that if at all the person, the buyer and the seller, they have agreed maybe to supply certain items to a given person, we must be able to know that which payment modes are those guys going to be using. Are they going to take these goods on credit? Are they going to be paying by cash? Are they going to be making partial payments? Or they are going to be using benefits in kind? You give me this, I give you the other one, in terms of a barter system like that. So we should be able to know, we should be able to actually know the payment terms for the goods that we are going to be supplying to each other. Then the other one is that the contract has a commercial substance. Something to have a commercial substance, it means that the contract must be giving rise to the monetary benefits. At least we expect that there must be an outflow of cash. If maybe you are just transferring the item, it is maybe a parent to a subsidiary, then when there is no monetary transactions that are going to be taking place, then we don't expect that to be called revenue or to be recognized as revenue. So it means we are not having a contract with any person, because there is nothing like any monetary benefit that's going to arise from both of the parties. Then the other condition is that it is probable that the entity will collect the consideration to which it will be entitled to. What we are looking at here is that the company can be able to collect the money for the goods they have actually supplied to a certain customer. If I'm the seller and I'm giving out the goods to a given, maybe a given retailer in a given location, we are expecting that it should be probable. And we said if something is probable, it means something it is beyond 50%. The chances of the person receiving the money or recovering the money for the goods they have supplied is more than 50%. Then the other one is the last one, as far as identifying the contract with the customer is concerned, as our first step model, we are saying that the contract can be written, verbal, or implied. What we are trying to look at here is that there are some instances whereby some contracts are not going to be written down, or you are not going to be having any agreement. If, let's say, you are going to maybe to a shop and you wanted to buy maybe a phone, you go there, you negotiate the price. After accepting the price, you pay the money. It means the contract was there, but it was verbally. The verbal communication you made when you are agreeing on the price or when you are bargaining for the price is actually a contract. So it is not necessarily that these contracts are supposed to be written, or they are supposed to be formally or formal, they are supposed to be written in any kind of documentation. But what happens within companies is that most of the times we may be having written agreements, and sometimes they may be even implied. And we are saying if something is implied, we may take a scenario. If let's say you're a company and you are dealing in transport services, we expect that these customers or the people you are transporting, by the time they enter into maybe the transport network, if let's say you are using a road, by the time they sit in your taxi, or by the time they enter the bus, you find that there is no need for you to ask them that, are you going to pay at the end of or are you going to pay for the transport fare? Because by the time the person enters and sits, we expect that that one is going to be a passenger. There is no document that you need to write with that person to confirm that you are going to receive the money. At the time the person sits, we expect that the person is going to pay the money without even asking. That's also a contract, but it is an implied contract. Then the other one is the one which is very common, the written one. You get the document, you sign the document. Mostly in these loan arrangements, you find these banks, you find they have a written document. Either you agree with it or you don't agree. But most of the time, once they give you their contract, most of the time it may not be an agreement, because an agreement is something you bring an issue. I say that one I want it, the other one I don't want it. But if let's say it is in the bank, they give you their loan application, you just fill in. It is a contract. It's a kind of one-sided agreement that it is the company that present to you what they offer, then it's you to choose whether you are taking or you are not taking. By default, when you sign, you have actually agreed to whatever kind of information that are embedded within the agreement. So that's one of the first step. The first step of the 5-step model that we go through so that we can be able to recognize revenue. Then let's try to look at the second step. And these conditions were examined in May 2019, question 3, Roman 1, question 3A, Roman 1. So you may cross-check and try to get to understand those points. Then the second one, we are going to be looking at, the second one is to identify the separate performance obligations. We've been talking about performance obligations. You have an obligation to do this. You have an obligation to do this. Or you have something to fulfill. Something is pending and you need to sort it out. So now what are we trying to look at here? We are trying to look at what does the seller, now we are now concentrating on the side of the seller, because it is the seller who is going to be fulfilling the obligation. If maybe I have bought a phone and that phone is supposed to be upon when I have paid as a customer, when I pay, you are expected to give me maybe the rest of the things that are supposed to be incorporated within the asset. Maybe you may give me the item, or I may buy it. And since we had an agreement, you find that I have taken it, but I found it was not working, then it will be the person to do the maintenance or to provide me with the new one, depending on the warranty agreement that may be incorporated or embedded within the agreement. So we are trying to look at what does the seller has to offer to the buyer in terms of fulfilling the performance obligation. What are you going to be delivering to the customer? If I'm the seller and we are saying that the performance obligation is a promise in a contract with the customer to transfer to the customer, either now these are the things that we transfer to or the things that we deliver to our customers upon fulfilling the terms that are within the contracts. One, we are saying that it may be a good or a service, or they may be a band of goods or services. But the condition is that those goods are going to be distinct. And they are going to be distinct words. That's one of the words that we are going to be emphasizing on. And we are saying something to be distinct is that that item is going to be, it can be sold separately, or it can work on its own. If let's say I'm buying a phone, but when I buy that phone, I find that that phone has a charger inside. It may happen that some customers, they may come and they say, maybe me, I want a charger only. I have a phone, but I just want to buy a charger. So if something can be sold independently, then we attach a price, as we say, the standalone selling price. If something that can function on its own and it has a value, someone can go and buy it as a unit. And we are saying it may be a good, it may be a service, or they may be just in a bundle, as we said, that maybe these items are coming at once. If maybe someone is paying tuition, when you are paying tuition, you pay a single sum, a lump sum amount of money for tuition. But you find that with that tuition, you are provided with the reading materials. You are provided with maybe revisions, and you are provided with even the lectures. But those items are coming at once. They're coming in a bundle or in a batch. So that's one of the items that the seller may deliver in order to perform or to fulfill a performance obligation. Secondly, we are saying a series of distinct goods. Remember, we are saying these goods are supposed to be distinct. These items can be distinguished, not these items that where one cannot function on its own and you start calling them distinct. There may be a series of distinct goods or services that are substantially the same and that have the same pattern or transfer to the customer. You may find that maybe the company has been delivering, maybe the company is engaging, let's say, is providing security. It is a security company and it is providing security services. But it has been providing those security services for a given period of time. That's basically what we are looking at when we say a series of distinct goods and services that are substantially the same and that have the same pattern of transfer to the customer. You may find that the person has been providing security services, the company has been providing security services on a continuous basis. It has been giving that company for years and years. Maybe the company has been giving cleaning services. And those cleaning services, they are given out at the same amount over a given period of time. So they may be a series or it may be a single item. We are saying that a good or a service is distinct if it is sold separately or if it could be sold separately because it has a distinct function and a distinct profit margin. What this means is that for something to be called distinct, it must, first of all, it should be having a value. That if I'm to sell this item, I'll sell it at this amount, and when I sell this item, I'm getting a profit component of this. That's basically what we are meaning by talking about the distinct. So we look at the third step. We said there are 5. It is a 5-step model. We've seen 2. And the third one is to determine the transaction price. And now when we are looking at the transaction price, we are saying it's all about determining how much the customer is going to pay the seller. Remember, in the second one, we've been looking at what are the items that the seller is going to be delivering to the customer. But in the third step, we are looking at how much is the buyer going to pay the seller for the amount of goods and services that the person has actually received. And we are saying that the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services. We are saying that for us to determine the transaction price, it doesn't mean that the person is supposed to pay us there and then. We may be having, the money may come at a later date, and we shall see how are we going to be treating all that amounts that are going to be coming in at a later date. So that's basically the third step. We are looking at the amount the customer is going to pay to the seller. And now the customer is only going to pay. Remember, the customer cannot pay when you have not actually fulfilled. But we first know the amount, then we know how much the person is going to pay after fulfilling the. Then the fourth one is looking at the allocation, or we try to allocate the transaction price to the performance obligation. Here, when we are trying to look at how we are going to be allocating the transaction price to the performance obligation. Remember, the transaction price is going to be the amount the buyer is going to pay to the seller. But the seller has an obligation to transfer the goods, of which those goods, they are the ones that are going to result in the price. And we are saying that when a contract contains more than one distinct performance obligation, a company allocates a transaction price to a separate performance obligation in proportion to the standalone selling price of the goods and services. So this is basically, if maybe we've been saying that these goods are supposed, most of the times the goods are delivered in batches. So if these goods are delivered in batches, then how are we going to be apportioning the consideration we've actually received towards those items? Because we said that even if you receive these items, some of the items for free, we are supposed, so long as those items can result in performance obligation, we are supposed to allocate a price to them. I've been giving you the example that if, let's say, DSTV is giving these dishes at maybe 180 as the price, but when someone buys the DSTV, that person will receive a 1-month subscription that is free, but it is inclusive. But remember, each monthly subscription has its own price that is separate from the cost of the dishes. So even if someone pays 180 as a single unit for both the dish and the subscription, the monthly subscription, we have to determine what is the proportion of those two items that we've actually received on top of the money that the customers paid. If you have paid 180, but maybe the dish was maybe, if someone is to take the dish alone, is supposed to pay this and this amount. Maybe you can try to look at some of the very lively example, because you may find that in the dish arrangement, those DSTVs, for them, when they are selling, they sell them at once. Everything is intact. They can't separate, but each has its own value. That's what we are trying to mean. But if you are trying to look at a very clear example we may look at is if we are paying for these professional courses, maybe CPA. If you're studying CPA, you are paying each amount of money to study this CPA. Maybe you are paying, let's say, $50 or whichever amount. Maybe you are paying $50 for each paper, maybe to study financial reporting at a given college, wherever you'll be attending from. But that $50 you are paying is inclusive of the reading materials, and at the same time includes even the revision classes, and at the same time it includes even the normal classes that you are going to receive as lectures. But there may be scenarios whereby you may find that there is a customer who may come, or there may be a student who may come and say that me, I'm not going to be attending classes. I want only revisions. How much am I going to be paying? In proportion to the total $50 that someone pays when the person is going to acquire all the service. That's basically what we are looking at when you are saying that we allocate or we apportion the transaction price, the amount we have received from the buyer, to the performance obligations. So that's basically what we are saying in that. Let's try to look at the third, the last step when we are recognizing our revenue. And this last one is by far the most important step. We are saying that we recognize the revenue when or as a performance obligation is satisfied. This is very, very, very important because we've said that you are going to look at scenarios in exam past papers that maybe a person is required, they had a contract, and on that contract, before even they supplied anything, they gave them a deposit or a down payment. But that down payment, you have actually received that money, but you have not yet worked for it. It means that money, we can't recognize it as revenue in that very financial period because we have not worked for that money. So we are saying revenue should only be recognized when or as the performance obligation is satisfied. If, let's say, the contract was to supply 10 computers, at the point you have actually supplied the computers to the customer, so long as the customer has accepted the goods, of course, we are going to be saying how do you tell that the customer is satisfied? Because you may take the goods and the person says, these are not the right quality I wanted. So we're not expected to get the money. So we are going to also look at some indicators as we shall see. But what we are trying to look at here is that when you have supplied the items and the customer has accepted the items, whether the person pays there and then or whether the person doesn't pay, it means you recognize the revenue there and then because we are using accrual basis. That we recognize cash, not necessarily when we recognize the revenue, not necessarily when cash has been received or has been paid. So that's basically what we can look at. But what you should know, we are saying that the entity satisfies a performance obligation by transferring control of promised goods. Remember, we started by looking for the meaning of the word control. If someone has control over something, it means the person can direct whatever they want to use or whatever they want to do with the asset, and they are able to get all the benefits that are associated with the asset. And we are saying the person or the seller is going to transfer the control of the promised goods or service to the customer. A performance obligation can be satisfied at a point in time or such as when the goods are delivered to the customer or over time. Basically, what we are looking at here, we are going to look at some of these performance obligation. What do we mean by performance obligation satisfied at a point in time and over time? At a point in time, if let's say I was supposed to transfer 10 million to someone's bank account, maybe in US, and I have actually transferred the money. If I can do that there and then, it means I have done that at a point in time. But if the performance obligation, I'm going to satisfy that over time, it means that this performance obligation is going to be existing for a long period of time. Some of these are the contracts, those long-term contracts. Maybe it is a construction company and they have got a tender to construct maybe roads. You may find that those roads are going to take a very long period of time to be completed. So the performance is going to be there in stages. We'll be looking at the stages of completion, at different stages of completion, and we'll be receiving different amounts according to what we have actually completed. So we are going to look at these items in details, but that's basically what step 5 is very important. We don't recognize money when you have not satisfied the obligation or when you have not fulfilled the contract. We have an example here, but that one we shall look at it at a later date, because this is basically the computations of what we've been talking about. But I wanted to first do away with these items. Then let's try to look at these performance obligations and we'll try to look at them in details. We are saying that performance obligation satisfied at a point in time. We are saying that a performance obligation satisfied at a point in time at the point at which the customer obtains control of the promised asset and the entity satisfies the performance obligation. At the point when you have transferred the item, if maybe the person bought a car from abroad, and that person is supposed to be, the car is supposed to be imported from wherever it's supposed to be imported and supposed to be delivered or transported to the buyer's place. By the time it reaches the buyer's place, then we can now say that we've actually satisfied the obligation. So let's try to look at what are some of the indicators or what shows that we've actually transferred the control. It's now we've been owning a certain item, but now we've actually transferred the item to a different owner. One, we are saying that the entity has a present right to pay for the asset. Of course, what we are looking at here is that if the person has actually received the goods, then the person is required to pay us because we've done what the person wanted. So that's one of the items, and we are saying that when goods are delivered to the customer, then the entity will be entitled to receive the payment. By the time you receive the payment, it means you have actually transferred the ownership, or you've transferred the right or the control. Secondly, we can talk about the customer has legal title to the asset. If maybe we've been selling in old items, maybe motor vehicles, but we still have those land titles in the name of our company. Maybe if you have been selling land and we have different plots of land, at the point when we transfer those titles to the name of to the names of the customer, then it means we have actually transferred the control, meaning the person can do anything on that land because the land now belongs to that person. We are saying that the customer is now owning the item upon delivery. If at all you have given the land title to the person, it means the person can now do anything they want. They can even sell it for anything they want. Then the third one we can look at is that the entity has transferred the physical possession of the asset. This is self-explanatory. We are saying that there is someone says that we've actually transferred the land title in the names of the buyer, but when the buyer has not actually received the land title. So when we actually transfer the land title into the names of the buyer, and we actually give the land title to the buyer, it means that the person is now fully in control of the asset. The fourth one, we can look at that the significant risks of ownership, risks and rewards of ownership have been transferred to the customer. There are certain items which I need to classify as far as this point is concerned. When you are talking about the significant risks, we say that if maybe I've been holding the item, maybe you've been paying the item on hire purchase. I've not given you the item, I'm still having the item, and by the time I transfer the asset to you, some of the risks may arise. One of the risks we may find that at the end of the day, that land title, someone may steal that land title when you are the one with it. By the time they steal it from you, it means me, I've already lost the control. You can't demand me because I gave you the control. If you lose the title, it means the risk is on you. Then in terms of the rewards, as far as land is concerned, you may find that I have bought land, let's say 20 million. But by the time you make the transfer and you give me all my documents, the land has increased in value. And it is now the land which I bought at 20 million, it's now costing 25 million. That difference or that increment in the price because of maybe inflation and market forces of demand and supply, whichever causes the price to rise, has made me to benefit. Because at the end of the day, I paid less money, but right now, if I'm to revalue the asset, I'm getting a lot of money. So those are the benefits and the risks that are associated with the transferring ownership. Then the last one, we have that the customer has accepted the asset. This is very key because you may say that the customer has paid the money. The customer paid the money and we have delivered the goods, but the customer reaches there and says, man, these are not the quantities I wanted, or these are not the qualities I wanted. Take them back and bring for me others. I did not order for this. But if the person satisfies with what you provided, or what you have actually provided, satisfy the customer's demands, then we say that the person is now entitled to re-giving you the money. And from there, we are saying that the performance obligation has been fulfilled. There is one simulation that we may look at, August 2019, question 2B, but this, I'm not going to go through the questions. It's better we first handle these theoretical aspects. When we deal with them, we can be able to recap and get more clarity as we are going to be doing the computations. Then let's look at, we've been looking at the performance obligation that has been satisfied at a point in time, at a given point in time. But now we are satisfying the performance obligation over time. Over time, it means that these are long-term satisfactions that have been given a long-term contract. Maybe I'm to construct a road, and that road is going to take maybe 5 years to its completion. What will happen? I will not need to wait until 5 years for me to start receiving payments. Because you may find by the time I started the operation, I also needed to be having some money to to be used in operating there, to be used to be used as working capital to cater for the day-to-day operations that are going to be existing within the process. So by the time we look at this, you should realize that at a certain point, we are going to be receiving different amounts at different stages. You may find that someone has been given a contract, maybe to construct a flat, but maybe the person has now constructed. You may find that in the contract, the person is supposed to receive payment maybe when they have completed the first floor. And you find that by the time they complete the first floor, they can request for the money. That is at a certain stage of completion. By the time they reach to the third floor, they have received part of the money. So how do we deal with such transactions where we are going to be receiving money at a different stages of completion? We are saying that a performance obligation is satisfied over time if it entered into more than one accounting period, something that goes above one accounting period or 1 year. It means it's something that is going to take long. We are saying in this type of contract, an entity offers an enforceable right to payment for performance completed to date. You are not going to wait until you complete the building for you to receive the payments. When you do something, you can ask for a portion. These are the things that are happening maybe for those construction companies, those companies that are doing contract work. You find that they are receiving money at a different stage, depending on how their contract is arranged. And actually, this is what the other standard was looking at. Because this, remember, this standard combined two standards. It means that this was the IS 11 that was concerning about the construction contracts, those long-term items. But now the new IFRS 15 mixed it, and we are looking at it as something that is a one-off item. So we said that we are going to be receiving money at a different stage of completion. But how are we going to be determining the stage of completion? Because not at every stage that you are going to be asking the money. If, let's say, maybe you are supposed to construct a house and you finish the foundation level, then you start asking for money. You may find that in the contract, they have specified that if you are to ask the money, you must have reached somewhere. And for you to make sure that you have reached somewhere, it means they are going to be having some certified work. You find that for this point in time, we've actually certified that we have completed this. Certified work means something that has been completed. Maybe the engineers have confirmed that at least we have done this. We are saying we have approaches that we use to determine the stage of completion. One, we have the revenue approach, and how we determine the stage of completion using the revenue approach, we are looking at the work certified to date or the actual work we have actually completed to date over the total contract revenue, we multiply by 100. That will give us a percentage of what we have completed. You may find that if it is 50%, it means you have done 50% of the work. Because what you have done, the worker certified or the worker done is half of the total contract revenue. So it means that will determine how much someone can give you. If let's say the total contract was for 10 million, and you have actually done 50%, someone may say that I'm going to give you 40%. When you complete another level, I give you another one. Then the other one is the physical units approach. Here we are looking at if these items, they are now not measured. They are not measured according to the work done, they are measured in units. If maybe you are required to produce 10,000 units and you have so far produced maybe 5,000, then what is the percentage of that, of what you completed vis-a-vis what you are supposed to complete? Then we are saying the stage of completion using the physical units approach is the units completed to date over the total contract units multiplied by 100 to get for us the percentage. Then the other approach, which is the last one, is the cost approach. When you are looking at this cost approach, we are looking at how much have you incurred in terms of the costs. How much have you incurred in terms of the cost vis-a-vis the estimated cost that you are supposed to incur at the end of the operation. The stage of completion now will be the cost incurred to date minus the closing stock. This closing stock may be in terms of the materials that you have not actually used. If let's say you budgeted that, no, when you are constructing this building, it will consume this and this and this much of the material. But you find that when you have completed maybe the first floor, you find that some of the materials are still available. So you list those materials and you divide by the total estimated cost, the whole estimated cost for the contract. Then you multiply by 100. Those are basically the ways we determine the stage of completion of how we can be able to use and get to know how much we can ask from the person who has given us the contract. That's basically how we can determine that. Allow me go take you through to some of the contract asset. We'll try to look at how do we determine the contract asset or the contract liability. Because some of these things are going to result, either we are going to be having a contract asset or we are going to be having a contract liability. So how do we determine those ones? We are saying that a contract, as contracts that span for more than one accounting period, now we are looking at how are we going to be determining the contract asset or the contract liabilities for those long-term contracts, the contracts that are delivered in more than one accounting period. We are saying as the contracts that span for more than or that go for more than one accounting period, okay, we are saying about these contract assets and liabilities. We are going to be seeing the amount that you are going to be recognizing, and we see how we are going to be computing. We are saying we have the actual cost that we have incurred to date. We add the recognized profits, if there is any recognized profit. Of course, if you have not recognized the profit, it means we are going to be recognizing losses. Losses, we are supposed to be deducting them, but the profit, we are supposed to add it back. Of course, what will happen with this is that if you have actually incurred 10 million, but the amount that you are receiving is maybe 12 million, you find that you have made a profit, and that profit is what we are talking about. This one is more or less of how we are going to be getting our sales minus the expenses, what we have incurred. If there is a loss, you less it. Then we have the receivables, the amount invoiced. We said that at certain point, you are going to be asking for money at different stage of completion. So if you are going to be asking for money at certain stage of completion, it means that even these amounts you have actually received, we are supposed to less them off so that we'll be able to get what is not yet received. Then when you less that, you are supposed to be either getting a contract asset or a contract liability. And a contract asset will be taken to these figures are going to be taken to the statement of financial position. Either they are going to be an obligation or they are going to be an asset. But remember, since we are dealing with these long-term things, then they may be going in terms of the long-term assets or the long-term liabilities. There is an example there, but we shall look at those ones later. Let's try to look at these contracts. These are basically the contracts that are resulting in losses. When you are actually making losses, you are engaging the contracts, but you are actually making losses. And how do we ascertain these losses? We are saying that once a loss is ascertained, it must be recognized in the statement of financial position as an expense. But the contract revenue must be limited to the stage of completion. You may find that at a given stage of completion, what you have actually incurred is more than what you have got. There we are supposed to be recognizing those losses as an expense. Those are very brief ideas, but we are going to be looking at them when we are doing the computations. That's when we'll be able to understand most of them. Let's try to look at the second last point, and we'll call it a day. It's all about the contract modification. We try to look at a contract modification. And we are in this, when we are looking at the contract modifications, one of the things we are going to emphasize here is that we are going to be looking at a scenario that results in a change in a contract. There are certain transactions that may happen and may lead to the cancellation of the first contract and you start adopting a new contract. There are other items that are going to be treated as they are not separate contracts. If maybe the person has been delivering 10,000 tons of coffee at the same place, but now they have changed the contract. Instead of delivering 10,000, it's going to be delivering 15 at the same place. I don't think there we shall be need to modify the terms of the contract. What we shall only do is to increase the value because the amount has remained the same. They are supposed to be delivering at the same place. So we want to look at some of these contracts that are going to be resulting us changing the contract or treating the contract as the same. We are saying that a contract modification is a change in the scope or price or both. In the scope, we are talking about the terms and conditions that are within the contract. Or it may be change of the price. If the price changes, of course, you need to draft another contract. Or they may be both. The contracts are changing and the prices are changing of a contract that is approved by the parties to the contract. If you have actually agreed to the changes, then you can redefine or remodify and you get a new contract that can be able to incorporate all the changes in the terms. We are saying that a contract modification exists when the parties to a contract approve a modification that either creates new or changes the existing enforceable right and obligations of the parties to the contract. These contracts, we said, there must be resulting either in a new contract or they are creating changes in an existing contract. We said if the terms are not changing, if the places are not changing, but what actually changes is maybe the location. You are supposed to deliver the 10,000 tons, but instead of taking them to maybe to Kenya, you are supposed to take them to Tanzania. But the rest are the same. And you agree that I can do that maybe at the same cost. Then there is no need of drafting a new contract. But there is a scenario whereby the people, you were supposed to transfer maybe 10,000 tons to Kenya, and now they are telling you take them to South Sudan, and even the costs are going to be changing, and the terms are going to be changing, everything is changing. So it will lead us to creating a new contract. We are saying, how are we going to be accounting for this contract modification when you have a separate contract? We're saying that contract modification represents a separate contract. That's what we are going to look at. We are saying that certain contract modifications are treated as separate new contracts. For those modifications, the accounting for the original contract is not affected by the modifications, and the revenue recognized to date on the original contract is not adjusted. Furthermore, any performance obligation remaining under the original contract continue to be accounted for under the original contract. Then let's try to look at what are some of the criteria that we are going to be following. We are saying that an entity shall account for a contract modification as a separate contract if both the following conditions are present. Remember, all the two, they are supposed to be present, not one. If one is present and the other one is not, it means we can't recognize it as a separate contract. One, we are saying that the scope of the contract increases because of the addition of the promised goods and services that are distinct. We are saying that if the terms of the agreement are going to be changing because we are adding in some additional items, we may be adding, we've been delivering coffee and now we are going to be delivering coffee and beans. We are adding another item. Then the other one is the price of the contract increases by an amount of the consideration that reflects the entity's standard and selling price of additional promised goods and services. And remember, those additional items, they are coming in with their different prices. Then we try to look at the contract modification where it is not a separate contract. What it means is that the same contract is going to be prevailing for all. One, we are saying that if a contract modification is not accounted for as a separate contract, an entity shall account for the promised goods or services not yet transferred at the date of the contract modification in whichever of the following ways. In whichever of the following ways is applicable. One, we are saying that an entity shall account for contract modification as if it were termination of an existing contract and the creation of a new contract. If the remaining goods or services are distinct from the goods transferred on or before the date of contract modification. You have been transferring beans, but now they are telling you to transfer coffee. Those are different items. Secondly, we are saying that an entity shall account for contract modification as if it were part of the existing contract if the remaining goods or services are not distinct, and therefore form part of a single performance obligation that is partially satisfied at the date of the contract modification. The entity would just update the transaction price and measure progress for the single performance obligation. This one we shall have a number, which is May 2019, question 3. We said we are considering questions that are above in 2008, because that's when the standard was introduced. So this is our last part, and we are going to be looking at how are we going to be accounting for the contract costs. And we are looking at what the standard guide has on the costs that we should capitalize and the costs that we should expense. What are some of the costs that we are going to be expensing, and what are some of the contracts that we are going, the costs that we are going to be capitalizing? Capitalizing means we are adding to the value of the contract. One, we are saying that the contract, the incremental costs of obtaining a contract. What happens here is that in a contract arrangement, we incur certain costs. Maybe we've got some brokers that have helped us maybe to acquire this deal. Remember, when you are selling this, maybe it was through a bid arrangement, and we've incurred some costs to those brokers that helped us to get the contract. It means that these costs are going to be directly attributable to the contract. It means that these incremental costs, the reason why they are saying incremental is because they are just increasing the cost of the contract, or they have incurred in addition to acquire. If they had not incurred them, they wouldn't acquire the contract. So if all those costs are going to be added to the cost of the contract, and they are supposed to be treated as an asset, meaning treating them as an asset is like we are capitalizing them. Such as we have the sales commission recognized as an asset if the entity expects to recover these costs. Because at the end of the day, when you get this contract, those costs, you are going to put them, and when you're putting these costs, it means when someone pays, is going to pay part of the money that is going to be for the contract plus the costs you've actually incurred. So long as you can recover those costs, then you are supposed to capitalize them. And we are saying that these costs that would not have been incurred had that individual contract not being obtained. Because these are some of the costs that if we don't incur them, we are not going to obtain the contract. And we are saying under Ifrs 15, these costs are capitalized or recognized as an asset and amortized over the useful life of the contract if they are expected to be recovered from the customer. I have incurred the cost when I'm inquiring this, when I'm inquiring about the possible customers that are going to come in to get the contract. But if at all I can recover that money from the customer, then I need to capitalize them. Then the other one, we can talk about the cost that would have been incurred regardless of whether the contract was obtained or then we have these other costs that even if you have not acquired the contract, these costs you are going to incur them. It means they are not relevant to the contract, but for them they are supposed to be paid there and then. If maybe you have staffs, these staffs you are paying them commission or you are paying them salary, whether they have made a sale or they have not made a sale, you are paying them. So if you are paying them, it means that even if they don't sell, you will actually pay them. So those ones, they are supposed to be expensed because they are normal costs that are incurred in the business operation. Then we have costs that are incurred in fulfilling the contract, unless within the scope of another standard. Because what we are looking at in these standards, we are saying that these standards shouldn't override each other. If some costs are accounted for under different standards, then we are not supposed to account for them if those costs are treated in a different standard, such as IS2 inventory, IS16 PPE, IS38 intangible assets, because we may be having some of these items and we have them, but there are some of the criterias. Because we are saying that there may be costs that are directly related to unidentifiable contract, such as labor, material, management costs, and others. The costs are expected to be recovered. That's a very big point, that if you have to recover those costs, and those costs, they are directly attributed to the asset, then they are supposed to be capitalized. And when you are capitalizing them, it means of course, after capitalizing, we go ahead and amortize. We get the amortization, which we are going to be taking into our financials. After amortizing, they are capitalized and we amortize them over the contract period. Then we have costs. That's more or less the same. They are consistent with the transfer, the custom of goods and services, with the asset index. But we have this, however, general and administrative costs that are not explicitly chargeable to the customer, and the costs of wasted material, labor, that were not reflected in the price of the contract are expensed. These are some of the things, but what you should understand is that most of these items that are not going to be capitalized, they are going to be expensed as and when they are incurred. So what you should have to understand is that the costs that are directly attributed to the cost, and those costs are going to be recovered, then they are supposed to be capitalized. The rest are supposed to be expensed, so long as they are related to the contract and they are not among the category that is going to be capitalized. That's basically what we can see. One of the things that we are left in this standard, as far as the standard is concerned, is doing the computations, and we try to get the whole idea after doing the computation. Those are coming in the preceding videos that are going to be coming in. Make sure you subscribe, share, comment, and send also to others to have a benefit, and also be able to improve our learning. Because by the time you subscribe to this channel, it means you are going to be notified. You subscribe, you ring the notification bell, so that you'll be able to receive whatever updates or whatever videos we are going to be uploading as far as accounting is concerned. Because this is not mainly CPA, but there are other professions like SCCA, people are going to use these materials and they are going to help them do well in their exams. So thank you for watching and never to subscribe.